Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Medical System Holdings Limited annual report. China Medical System Holdings Limited offers a wide range of pharmaceutical products across various therapeutic areas. In the cardiocerebrovascular segment, the company provides medications such as VLPHORO for seizure clusters and Xinhusu for acute heart failure. In gastroenterology, China Medical System Holdings Limited offers METOJCT for severe psoriasis and rheumatoid arthritis, LUMEBLUE for colorectal lesion visualization, Salifalk for ulcerative colitis and Crohn's disease, Bioflor for diarrhea, Combizim and Cytine for digestive enzymes, and Ursifalk for cholesterol gallstones. The company also provides dermatology products including ILUMETRI for plaque psoriasis, Ethoxyclarol for varicose veins, Hirudoid for skin care and acne-prone skin, V-Monalisa for dermal implantation, Ogentrophin mono eye drops for asthenopia, Iopone glaucoma treatment device, and Elcitonin for osteoporosis pain. In addition to these products, China Medical System Holdings Limited offers other services including modified sodium hyaluronate filler, polidocanol injection, mucopolysaccharide polysulfate cream, skin healing soothing product, and eye drops. The company's extensive portfolio of pharmaceutical products makes it a significant player in the Chinese market. China Medical System Holdings Limited market capitalization of $35 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that China Medical System Holdings Limited holds a significant advantage in their industry. China Medical System Holdings Limited trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 1.75 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 9% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 2.3%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, innovative products have been a significant contributor to revenue growth, with a 44.1% year-on-year increase. Exclusive and branded products also played a crucial role, accounting for 59.8% of total revenue in 2025. The company's strengthened in-house R&D capabilities, diversified commercial ecosystem, and multi-tier payer ecosystem have also contributed to its revenue growth. The development of an omnichannel system, which integrates retail pharmacy networks, e-commerce platforms, and other channels, has enabled the company to reach a wider customer base and increase sales. Additionally, the consolidation of specialty platforms and unlocking internal potential in core therapeutic areas have led to significant revenue growth. The company's exclusive and innovative drugs have also seen a 23.3% year-on-year growth. In terms of specific product categories, the skin health field has experienced the highest growth rate at 73.2%, followed by gastroenterology/autoimmune-related fields with a 3.3% increase. Cardiocerebrovascular-related fields and ophthalmology have also seen significant growth, with increases of 2.4% and 12.9%, respectively. On the other hand, the primary drivers of revenue decline can be attributed to several factors. The disposal loss from Shenzhen Kangmai and impairment loss from iTech Care, ETC, have both contributed to a decrease in revenue. Additionally, the skin health business revenue decreased by 8.7% from 2024 to 2025. The net income of the company experienced a mixed trend over the year. Initially, it decreased by 10.5% year-on-year, but later increased by 8.3% from RMB 5,422.2 million to RMB 5,871.5 million. However, this growth was largely offset by a significant decline of approximately 31.1% due to reduced sales from the top customer. Furthermore, the net income also decreased by RMB 100 million, transforming a loss of RMB 100 million into a loss of RMB 20 million. The profit margins of the company also underwent changes. The overall profit margin decreased due to non-recurring and non-operational items. However, excluding these items, the normalized annual profit margins remained relatively stable with a 3.6% increase. On the other hand, the gross profit margin decreased by 1.1 percentage points to 71.5%. Additionally, if all medicines were directly sold by the group, the gross profit margin would have decreased by 0.3 percentage point to 62.4%. The impairment loss recognized in respect of the group's interest in ETC due to unfavorable market conditions and lower than expected demand also contributed to the decline in profit margins. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, the operating cash flow status is listed as positive on page 163 of the report. This suggests that the company is successfully converting its earnings into actual cash flow, which is a crucial indicator of a company's financial health and stability. The company's debt level has undergone significant changes over the past year. Initially, bank borrowings decreased from RMB 831,300 to RMB 651,815, a decline of 21.5%. This trend continued in subsequent periods, with the total comprehensive income for the year showing no change in debt level. The total debt level also decreased by RMB 170,664 from RMB 860,743 at December 31, 2024, to RMB 690,079 at December 31, 2025. The interest expenses have also seen a substantial decrease. Interest expenses dropped by 47.4% from RMB 38.6 million to RMB 20.3 million in the initial period. This decline continued throughout the year, with interest expense decreasing from RMB 38,610,000 to RMB 20,297,000. The finance costs at December 31, 2025, were also lower than the previous year, standing at RMB 20,297 compared to RMB 38,610 in 2024. Overall, both debt level and interest expenses have decreased significantly over the past year, indicating a reduction in financial liabilities for the company. The performance of our company's segments and regions varied significantly over the past year. In terms of overall performance, the integrated business stood out as a shining star. This segment saw an increase in revenue, gross profit, and segment profit compared to the previous year, indicating a strong growth trajectory. On the other hand, the skin health business struggled to keep pace with its previous year's numbers. Unfortunately, this segment experienced declines in both revenue and gross profit, resulting in a significant loss. These contrasting performances highlight the need for targeted strategies to address the challenges faced by each segment and drive future growth. Management is optimistic about the company's future prospects, particularly in China's pharmaceutical sector. The company is entering a critical phase of policy deepening and reform, with a focus on high-quality and sustainable development. This strategic shift will be driven by two key engines: product competitiveness and commercialization. The company remains committed to its three core strategic pillars: product innovation, commercial model reform, and international expansion. Management is accelerating international growth through a global perspective and establishing an APAC hub. This expansion strategy aims to tap into new markets and increase the company's global presence. Management's emphasis on long-term investments suggests that they are prioritizing sustainable development over short-term gains. The company's focus on product competitiveness, commercialization, and international expansion indicates a commitment to growth and innovation. Overall, management is confident in the company's ability to adapt to changing market conditions and achieve its strategic objectives. The company has made significant transactions in the form of acquisitions and divestitures. In terms of acquisitions, the company paid RMB 1,480,664,000 to acquire intangible assets. This transaction is a notable addition to the company's portfolio. On the other hand, the company has also engaged in divestitures, which involve selling off certain subsidiaries or associates. Two such instances are worth mentioning. Shanghai Carnation Medical Technology Co., Ltd., a subsidiary, and Shenzhen Kangmai Biotechnology Co., Ltd., an associate, were both sold off by the company. These transactions demonstrate the company's strategic approach to managing its assets and investments. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently declared annual dividends per share, with a total amount paid out in 2024 and 2025 being RMB 556,162 and RMB 660,555 respectively. In addition to paying dividends, the company has also engaged in share buybacks. In 2024, it repurchased ordinary shares in treasury stock for a total consideration of $162,792,468. This demonstrates the company's commitment to returning value to its shareholders through both cash and equity-based means. That concludes the financial summary for China Medical System Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.